Great, I think we are ready to start up here. Welcome to all, good morning, good afternoon, wherever you're located. My name is Henrik Jeppesen. I'm the head of investor outreach focused on North America for the Carbon Tracker Initiative, and I'm based in New York City. Today, we will discuss one of our latest report called Event Horizon, a case study on holdback and the point of no return for decommissioning upstream oil and gas assets. That's quite a mouthful. Please download this report from our website if you haven't already done so. I'm very excited to introduce and to lead today's debate, and we have our excellent research team to discuss one of the latest groundbreaking research topics from the Carbon Tracker Initiative, asset retirement obligation or stranded liabilities. In other words, who is left to pick up the tab and pay for the plugging of and retiring of oil and gas assets when they are depleted, as the world moves away from use of fossil fuels. With me today, I have several of my excellent research colleagues to discuss these important topics. First, we have Stephen Greenslade, our ARO, Asset Retirement Obligation Analyst, who will present our latest report, Event Horizon, for about 15 minutes. He will be followed by Mike Coffin, who is our head of oil, gas, and mining research, to discuss stranded liabilities in the light of stranded assets, our core topic in our unburnable carbon report 10 years on, basically a follow-up a decade later from our original unburnable carbon report that started the whole carbon tracker initiative. He will also talk for around 15 minutes. And thereafter, we will have a moderated Q&A discussion with Stephen, Mike, and we also have our senior advisor, Dwayne Purvis, to help us in this discussion. Steve Purvis is a senior advisor and a petroleum engineer, and he has been one of the masterminds behind the holdback methodology that we are going to discuss here today. So please don't be shy and post your questions in the Q&A box you see at the bottom of your screen. We can also put them into the chat box. But so basically, what we first of all want to discuss here is the holdback report, and it's we have a little miss here. Here we go. Sorry for that. I had a little problem here. So in order to set the stage, I apologize for that little misunderstanding here, but to set the stage, US President Benjamin Franklin famously said, "In this world, nothing is certain but death and taxes." And we could be tempted to add, "and someone needs to pay for the retirement of oil and gas assets." In a report series we started in 2020, Carbon Tracker has spotlighted these emerging issues of potential stranded liabilities. And we have calculated that many of the US oil-producing states, i.e. their taxpayers, are facing potential of trillion-dollar retirement bubble if oil and gas companies are not paying for these costs. This is not only a US issue. There's several global jurisdictions which have insufficient regulation in place. So what we are going to discuss today is really the issue that US law require that oil field assets are properly retired at the end of their productive life to protect human health and environment. This is the asset retirement obligations. Under business as usual approach, many of these retirement costs will lie decades out in the future. But as we are transitioning away from fossil fuels and towards low carbon energy sources, this will shrink the demand for oil and gas and accelerate this process and lead to premature asset retirements, i.e. forcing companies to pay for these costs decades ahead of schedule. Very few companies are saving, making provisioning to pay for these retirement costs. So therefore, who is in the place to pay for these costs when we come to the end of life of the assets? This is what the asset retirement obligation discussion is about, and this is what we're going to discuss here today. So who is on the hook for paying these costs? Taxpayers or companies? Can regulation be changed? And what are some of the methods and metrics we can use in order to change this? This is what we're going to discuss here. So Stephen, you are much better equipped to really go into the deeper detail on the material. And so therefore I'll hand it over to you and you can share your screen.
Well, we switched it up on you, Henrik. I think Mike is actually going to take us first. So I'm going to pass it to Mike here, and we'll talk about stranded assets first, and then we'll discuss holdback and arrows toward the second half of the presentation.
Great, thanks very much, Henrik and Stephen. Great, so I can now see the slides. Perfect. I hope everyone else can see the slides online. And so today what I'd like to do, is just give a really high-level summary of our sort of narrative and story around stranded assets and really identifying transition risk, primarily for oil and gas companies, but for those invested in them. So really give a high-level summary of the risk facing them. Before Stephen can go into more of the detail from the liability side. In short, as the energy transition unfolds and accelerates and oil demand falls, then as oil demand falls, revenues for oil and gas companies will fall too, and that potentially accelerates the closure of fields and reduces the revenues from them, and of course provides less cash and to pay and meet their asset retirement obligations in the future. So talking through under the stranded asset story, and of course there's two parts to this. One is the urgent need to act on climate and therefore the policy risks facing companies, but two, and ever increasing, is the rollout of new technology, which is accelerating this transition and accelerating capital being deployed into it. So on the first slide, I think this is a summary of a recent piece of work that Henrik alluded to, so 10 years on unburnable carbon. I think it's just really setting the scene from a climate perspective, in that to limit warming to 1.5 degrees, 90% of the world's fossil fuel reserves, not just the resources, but the reserves, must stay in the ground as unburnable carbon. So you have on the left in gigatons of CO2, the emissions that are embedded within those reserves. So if they were all burnt, this is the CO2 that would result. And then on the right, we can see the remaining carbon budget for different temperatures. So for a 1.5 degrees C outcome, 90% of fossil fuels must stay in the ground. So it's critical that the global energy system pivots away from fossil fuels. It's critical to stabilize global climate and reduce the temperature rise that we all face, and the impacts of which disproportionately impacts some of the world's poorest as well. So moving on to the next slide, how do we impact? How is this energy system going to evolve? What are the levers we need to pull to effect this transition? So mobility is one of the biggest user or demand sector for oil. So on this chart, you can see we've got for the three main fossil fuels and then the non-energy usage of them. You've got oil, natural gas, and coal on the x-axis, and on the y-axis you've got the proportion for each fuel by the different use sectors. So mobility is that large sort of mid-blue color on the left-hand column for oil. So over 50% of oil is used for mobility. So ground transportation, transportation more broadly, be it on the ground in cars, trucks, or in the air as well, and of course train usage too. Now, that is one of the biggest use sectors and the biggest emitters. But so moving on to the next slide, fortunately, the rollout of new technologies, and particularly the rollout of electric vehicles, particularly within Europe, but increasingly more globally, that technology adoption is accelerating, and therefore this is now driving the significant reduction in oil demand. So on the left-hand chart, you've got EV sales per annum in millions, which is broadly equivalent to percentage market share as well of new sales. And we're still at the start of that curve globally. But as you can see, over the next, or through the end of this decade and into the next, new car sales will be dominated by EVs. Moving then onto the chart on the right, this will significantly impact total transportation demand for oil. So currently we're in a peak or very near the peak, and seeing that plateau and then plunge rapidly through the latter part of this decade and through the next. So what's enabling this? Well, it's the rollout of battery technologies, allowing the electric vehicles to displace primarily oil and also oil derivatives, be it petrol or diesel or aviation fuel, and leads to a reduction in internal combustion engine use. And drives down, therefore drives down demand for oil. And of course, electrification is one element to this, but of course that electricity needs to be clean in itself. There's no point in switching from oil to EVs if they're then powered by coal or gas. And so obviously this needs to be combined and is being combined with rapidly falling renewables costs. So the electricity itself that's powering these EVs can then be low carbon. So initially, you've had policy action on climate has enabled initial subsidies, initial development of these technologies, but now they're in a place where they become increasingly or ever increasingly commercially viable. So, for example, renewables costs are now falling well below gas costs in many parts of the world in terms of, or most parts of the world in terms of electricity supply. And we'd see existing or current, high commodity prices potentially accelerating this switch in the coming years. So you have a policy and technology reinforcing each other to drive down demand for oil and gas. So if we move to the next slide, and this is just looking at oil demand over the next 2 decades. And really, whether you look at oil demand through a low carbon and sort of an imperative to limit global warming, and therefore policy action must happen to reduce emissions, or you look at it through a fast transition lens, or a combination of both, i.e. fast transition because of the rapid rollout of new technologies substitute for the fossil system, under either lens, demand falls, and potentially quite rapidly for oil. So the chart here is looking at the future supply and demand of oil and gas, for oil only. So in the grey, you have the future supply from existing projects. So through natural decline, that production declines through over the coming 2 decades. And then what we also have is 3 scenarios, and these are IEA, International Energy Agency scenarios for global oil demand. And so you can see the net zero emissions scenario, a 1.5 degree scenario. Actually, we already have sufficient oil from existing projects to meet demand under that scenario. Under a Paris scenario, 1.65, the blue scenario of the sustainable development scenario, there is just a small amount of a small supply gap. So therefore, just a handful of new projects are needed to fulfill the supply under that demand scenario. We look under the stated policy scenario, a 2.7 degree scenario. We see that broadly as a proxy for business as usual behavior. So we see that the industry and many companies are planning on a slow transition 2.7 degrees scenario, whereas the reality is either through policy action on climate or increasingly from out competition and renewables growth, we'll see a faster transition, which will see lower demand for oil. And this potentially accelerates through into the late 2020s and into the 2030s, particularly if we look at some of the S-curve deployments, as we saw in the previous slide, if the rollout of new technologies really accelerates. So you may have shorter, sort of an elongated plateau in the short term before an even more rapid fall off later this century. So we're just saying some quite simple scenarios here. Clearly, there are other scenarios of different temperatures with a slightly more complex shape. But actually, at this point, we're looking at the aggregate demand over the next 2 decades or so. So if we move to the next slide, just to really sum up, lower than expected demand impacts future returns. That's just really the crux of the issue here. Lower demands, fewer projects needed, lower long-term pricing, and therefore it is critical that companies plan for falling long-term demand. So we've got to take action now, particularly given the duration of oil and gas projects. So they take time to build and then time to produce. Ultimately, new projects being sanctioned out are taking a punt on what oil prices are going to be over the next 2 decades. So it's critical that companies plan for falling demand and falling prices. So why should anyone else care? So if we look at the next slide on stakeholder implications, why should different groups and different stakeholders care about this? I mean, from an asset owner perspective, it's about obviously matching these assets and the financial instruments in which the asset owners hold and their exposure to the underlying oil and gas assets through the companies. Do those match their future liabilities? Say, for example, for whether that's for a defined benefit pension scheme, or, for example, for a large university endowment. Then, do investments in oil and gas provide the same risk and return profile that's been expected, particularly if oil and gas companies are shifting from a sort of an income model, and for those companies that are shifting to new revenue streams and looking to grow in new areas, does that risk return profile, is that still the same thing? Asset owners are potentially exposed to very rapid changes in market valuations as market sentiment increasingly reflects some of these risks. You just have to look at the valuations for coal companies 10 years or so ago. Looking at the asset managers, obviously The key risk there is a risk of AUM loss through underperformance, but increasingly also pressure from the asset owners to invest more sustainably and potentially for impact. Do the products they offer, do they match what the asset owners and their beneficiaries are looking for? Do ESG products that are just based around disclosure, do those really actually capture and reflect the underlying risks associated with the transition? And is there a need to move back towards more active ownership and potentially more active stewardship of some of the assets as well? And finally, from a policymaker perspective, this is a key focus of one of our recent reports. How does this impact national revenues, particularly through taxation, and for those petrostate economies and national oil companies? What are the receipts there through what are effectively national investment vehicles? What is the opportunity cost of that national wealth that is being invested into projects that may fail to deliver return and erode value? And that wealth could have been spent elsewhere to deliver those same returns. What is the role of subsidies in perpetuating an industry that is effectively in decline and potentially is a significant risk going forward? And then finally, what is the compatibility of ongoing support, whether that's through subsidies or through support via the financial regime and financial markets? What's the compatibility of that with pledges and national climate commitments? So if we move on to the next slide, just to talk through what are the implications of the oil price on the transition. So under a fast transition, so lower demand for oil and gas, we'll see long-term prices fall, all else equal. Now, what we're showing here is a cost curve of global potential new oil and gas projects, where you've got the break-even price on the y-axis and then the oil demand and supply on the x-axis. Now, we're looking in aggregate supply over the next 2 decades, but under a 1.65 or Paris-aligned scenario, i.e. a fast transition in the blue, you need just an aggregate of around 5 million barrels a day of new supply. Conversely, company planning for business as usual, a slow transition needs more like 20 million barrels of oil a day. So taking those demand up to the cost curve and then across to the y-axis gives you an output price, all else equal, that's around $15 a barrel lower in the fast transition case as opposed to the slow transition case, as indicated by that big red arrow on the right. So the prices fall, produce a surplus for existing projects. Of course, if projects in the cost curve between those two demand lines are sanctioned, and the demand does fall as the energy transition unfolds, those unneeded projects risk becoming stranded assets. Those are assets that are sanctioned, a lot of capital has been committed, but those then just fail to deliver the expected return, ultimately eroding value for shareholders. Significant opportunity cost that capital could have been deployed elsewhere, potentially deployed into the opportunities that new technologies afford and offer for growth as part of the new energy system. So that's why prices fall, all else equal in a macro sense. So moving on to the next slide. Obviously, we're in a period of high oil and gas pricing right now. Clearly, that's been 2 very major shocks to the system over the last 24, 30 months or so. But given the time horizons, it's critical you don't invest for the long term based on short-term pricing. So right now, have higher prices. And actually, there are some scenarios that could be considered Paris-aligned. So slightly slower transition, but still Paris-aligned, looking at it through an alignment lens. For example, the forecast policy scenario, which is shown there in purple, where you see oil demand not peaking until mid-decade, but then mid this decade in 2025, 2026, before then rapidly falling out to 2040. But what's critical here is the timeframes in terms of oil and gas asset lifetimes versus the timeframe over which technology shift and new technologies will be adopted, but of course also the potential to policy action. So a significant risk of overinvestment in the short term on assets that are expected to deliver over the long term, as prices fall away, significant potential for value erosion over that period. So what is critical, and this talks to a report we put out in January this year called Managing Peak Oil. It's critical that you have a managed investment case to reduce oversupply, where on the left-hand side is just sanctioning all projects up to $60 a barrel over the next 5 years out to 2026. And then you see in that red wedge, you have significant oversupply under that scenario through the 2030s and beyond, hence likely depressing prices yet further than we just saw. Conversely, if you focus just on longer cycle projects, only the cheapest or lowest cost longer cycle projects can be needed, up to potentially $40 a barrel break even, and some shorter cycle projects, so for example, some shale to slightly higher price, you can better match supply and demand and reduce value loss as well through that. So really, it's critical that companies adopt a managed approach to the peak oil, and that investors engage with them to do so, that the companies are disclosing adequately their capital investment plans, and so that investors are able to challenge them and hold them to account, but crucially to understand the risks to which they're exposed through the assets in which they invest. So to sum up from my side before I hand over to Stephen, so these are the three key takeaways: fast transition, reduced demand for oil and gas, and then lower revenues. Companies must plan for the peak to avoid wasting capital, and there's significant opportunity costs associated in doing so. And then the final question really, does oil and gas still fit the risk return strategy for asset owners and the beneficiaries, and how? And then clearly there's a role there in terms of the exposure that asset managers are placed, the exposure to which impacts asset managers as well in terms of the products that they offer. So that was sort of a high level run through some of our key messages around stranded assets and the risk of the energy, financial risk that the energy transition poses to oil and gas companies and their investors. So Stephen, I'll now pass over to you for your slides. Thank you.
All right, Mike, thanks very much. So in this section of the presentation, I'm going to briefly go over asset retirement obligations, the unique financial risks they pose to the oil and gas sector in light of the energy transition, and their relationship to these other transition risks described by Mike. And then I'll give an overview of the key points from the recent piece entitled Event Horizon, and introduce an analytical framework demonstrated in the piece we call Holdback, which is a variation of cash flow analysis that can help investors, regulators, and all sorts of other stakeholders to better model and forecast these risks. Now, to give credit where credit's due, Holdback is a term developed by a longtime petroleum engineer who's already been introduced. He's up here at the top of the screen, Dwayne Purvis. He was the lead author on Event Horizon, and we're lucky to have Dwayne with us today. He'll be able to answer any questions that you all might have after I get through this short slide deck. So for a brief review of asset retirement obligations, Henrik already covered some of this stuff, but I just want to make sure we have the table set for this conversation. AROs are legal, contractual, and/or regulatory obligations to plug wells, to decommission infrastructure, and to remediate and restore the surface after the cessation of hydrocarbon production. So AROs are reported as additions to corporate debt in financial statements, and they make up one of the largest classes of debt for the oil and gas industry. Because of heavy discounting and non-transparent ARO reports, which we've covered in other research here at Carbon Tracker, the full scale of global decommissioning costs is not currently known, though there's some instances where we've gotten a snapshot. BP recently disclosed their full global undiscounted ARO in their last 10K, and it was around $26 billion, which is around 28% of their market cap as of yesterday's close, based on what I just checked yesterday. So AROs are significant. They're a growing issue, and they may represent a highly material risk to oil and gas investors. Now, what makes AROs a unique issue in the oil and gas sector? Well, unlike other major industrial sectors subject to ARO reporting, oil and gas companies are not required to set aside any cash for asset retirement. Instead, it's generally assumed that AROs are settled. The AROs that will be settled next year will be paid from next year's operating cash flow and so forth. This has worked so far, but obviously facing, in light of the energy transition, this paying out of cash flow is not a sustainable strategy for the long term. And as the portfolio of outstanding retirement obligations grows globally, that's the portfolio of wells and infrastructure that we continue to develop at a greater pace than the retirement of old infrastructure, the total cost grows and will likely equate to trillions of dollars worldwide. Carbon Tracker's estimated that we have $280 billion just downhole plugging costs onshore in the US alone. So, and there's some indications that even that's a low estimate on this. And plugging is just one and not even the most costly often piece of the picture when it comes to asset retirement. Now, meanwhile, the industry approaches several critical inflection points, as some of which were mentioned by Mike, one being peak oil demand, which will fundamentally shift the market and will bring forward the retirement of oil and gas assets across the board, pretty much, especially low producing assets and those with a higher marginal cost of production. So there's a lot of currently producing assets or assets that will be developed over the next few years that for which the expected retirement date by companies is way farther in the future than what we'll actually see in over the next few decades. What this means is there will be fewer productive assets to retire an increasing volume of AROs as they mature over the next few decades. And this is all part of a dynamic which we at Carbon Tracker have labeled ARO acceleration. Now, ARO acceleration is a risk. It's a dynamic that could be the topic of a whole webinar. But the key point here is that the dynamics discussed by Henrik and Mike that will drive increasing pressure on oil and gas industry balance sheets and potentially diminish asset values and returns will also impact the operating margins of oil and gas companies and drive up reported liabilities on the balance sheet, resulting in potentially significant destruction of shareholder value. These processes are interconnected and they form a positive feedback loop that will accelerate in unpredictable ways over the next decade, 2 decades, 3 decades. So in short, ARO acceleration and other transition dynamics feed off each other, creating complex risks that will impact shareholder capital and pose potential solvency issues for oil and gas companies on both a balance sheet and a cash flow basis. And the gross impact could be valued in the trillions of dollars. With respect to asset retirement risks in particular, companies may come to owe more in AROs than they can expect to pocket from all future production. And though the inputs to model this equation are generally known or knowable, widely used evaluation metrics frequently miss the crossing of this boundary line, which of course brings us to event horizon. So event horizon is all about this particular dynamic, this point in time when companies' decommissioning costs, their AROs, equal and then surpass all future cash flows. For today's presentation, I'll keep it pretty high level, but in event horizon, Dwayne discusses the cash flow trap in oil and gas assets that results from a failure to appropriately assess the value of oil and gas investments against the cost of asset retirement over time. And he demonstrates holdback analysis on 2 transactions. So really interesting case studies. I'll cover holdback in more detail in the next few slides. But just to kind of give you a sense of what we're talking about here, it may help to think of holdback as the period toward the end of a well's life or any bundle of wells, any oil and gas investment's life, when all the net revenues, the point in time in which all future net revenues must be held back in order to cover asset retirement. So yeah, if you haven't already, I encourage you to read Event Horizon to see a more detailed treatment of these issues and to check out the methodology that Dwayne's developed. There we go. Now, I just want to be clear on what holdback is and what it is not. Holdback is a lens for evaluating cash flows in light of asset retirement costs in order to estimate the point in time when all future net revenues equals the cost to retire the asset on an undiscounted basis. What holdback is not is a strategy for companies to save for asset retirement or manage risks in most cases. There's a lot of reasons why we don't recommend this as the best case or as best practices for asset retirement savings. Instead, it's really a heuristic for exploring asset value and exploring risk over time with respect to decommissioning risks. So the underlying methodology is relatively simple. We're talking about undiscounted cash flow. Holdback analysis estimates the undiscounted cash flow using industry standard methods, excuse me, using industry standard methods while incorporating the cost to settle the ARO as the final cash outflow. It may take years for a development to pay off its initial capital costs. And similarly, an asset may generate modest cash flow for years after the undiscounted value of all future revenues falls below zero against retirement costs. Now, this is a pretty logical and predictable dynamic. I think, generally speaking, it's probably relatively well understood if you put it in a schematic like this, but by and large, it has not been properly internalized into oil and gas investment or regulation, and that's really helped to grow this huge problem of underfunded decommissioning costs. Now, discounted cash flow metrics like net present value, they fail to point out this shift from asset to liability, and we cover that more in Event Horizon. Event Horizon, in that piece, Dwayne applied holdback analysis to several well transactions to look at how much residual net value existed at the point of transfer for two particular transactions. And I'm not going to get into the particular details, although feel free to ask Dwayne if you've read through and you want to know more about that. But I just want to quickly walk through some of the key points that we can see here in these two charts from the report. The holdback period is shown in red. And on the left-hand side here, we've got the net revenues period by period, so on a monthly basis here. And then over here, we've got the residual net value over time. And as you can see, this transition from blue to red, from positive net value to negative net value occurred while there was still some positive cash flow happening with some of these wells. But then you can see here, I put a little red star, so you can see the point of the last transfer of these wells to its current owner, which was a number of years after we estimate that the holdback period should have begun. This dynamic is widespread. I mean, there's no reason without evaluating transactions, companies, assets with this straightforward lens, holdback, it's relatively easy for an investor or a regulator to miss this shift, and that really poses a lot of potential risks to investors and to taxpayers, and so it's something that we think is really critical for people to start to grapple with and to start incorporating into valuations and transaction due diligence, etc. Okay, let's go forward here. So we're almost to the end of the slides. Before I wrap up, I want to stress that holdback is not just a forensic tool. It's not a newfangled, complicated method for valuing oil and gas assets. It's really a framework for applying standard financial analytics to forecast energy transition risks in the oil and gas sector. It can be applied using publicly available production data and cost inputs that are readily available in the marketplace. The hardest part often may be figuring out a reasonable estimate for the ARO, because as I mentioned before, and as we've covered in other research, companies aren't particularly good at reporting that number in a way that's transparent and defensible. Although Carbon Tracker's cost model and our other research on this issue can help to start bridge that gap as we get closer and closer over time to a real understanding of what the full cost to retire the industry will be. Also, I want to point out that holdback, given that it's a straightforward standard cash flow estimation technique, it pairs naturally with energy transition scenario analysis and can be a part of sensitivity testing on companies, on assets, transactions, jurisdictions against a range of future price forecasts, which can aid in investment planning, risk management, and regulation. And I personally think that all of those spheres really should start to incorporate this lens in order to get ahead of these risks. Regulators can apply this methodology to stress test companies operating in their jurisdictions, or to get a better sense of when and how to secure more financial assurance. Industry can and should use holdback to responsibly plan for asset retirement and to avoid potentially seismic financial impacts from changing regulations. I want to just repeat I don't think holdback is a best practice for saving for retirement, but it's a critical methodology for understanding retirement risk. But to give you a recent example here, under Colorado's new financial assurance rules, some companies may be required to pay tens or hundreds of millions in additional financial assurance in the coming years, among other new costs imposed by the regulations. And you know, the companies haven't been planning for this seismic shift, and especially for some of the smaller and mid-sized companies, it could be a significant financial burden. Regulators in major oil-producing jurisdictions around the world are increasingly engaging on this issue, and companies caught unprepared could be severely impacted, and so can investors. And finally, holdback is more than just a method. It's a way of seeing the energy transition that illuminates hidden risks. Holdback as a lens can be applied to a single well or to an entire oil or to the entire oil and gas industry. Now, modeling that gets more complicated, but conceptually it works at every scale. Right now, the industry is spectacularly failing to plan for retirement, and no one's telling them they have to. So why would we expect that they would do that? Pay money that they aren't being required to, when there's really no financial incentive for them to do so. But the past and present failure of understanding this risk has created this really, it's wound the spring really tight. And so the only reasonable choice in light of the circumstances for industry, for investors, for regulators, and other interested parties is to carefully map out this issue, run the numbers, and plan accordingly. So yeah, that's pretty much it. Just for a basic recap here, stranded assets and other energy transition risks mean less money for AROs. ARO acceleration means less cash from the assets, and that retirement costs brought forward in time. The energy transition means more stranded assets and ARO acceleration. So those all work together. Trillions of dollars in combined financial impact, both balance sheet and cash flow implications. Without planning today, the industry could, at some future point in time, the industry will shift from positive to negative net value. And certainly many companies will do so before the industry does so as a whole. And so it's important to really start to grapple with this question. And holdback analysis, really the holdback lens, can help companies, investors, regulators, and all other stakeholders to get a handle on this risk and help to formulate appropriate strategies going forward. And so that's all I've got today. I think we can move it over to the question and answer.
Fantastic. Thank you so much to Mike and also to Stephen, and apologize for the little mix-up in the beginning. But I think a good way to start is actually also one of the questions that came in here, both for Stephen and for Dwayne, maybe to clarify and so on. So does this logic also work for shale projects, or is it primarily for the big oil majors? And does it apply both to new investments, or is it primarily to existing wells and projects out there? I don't know which of you would like to start out.
Let me start with
Dwayne.
that.
Dwayne.
Yes. Good morning, all. I am joining you from a cafe in East Texas, where I'm here today to talk to a bunch of petroleum engineers about the holdback. And these are folks who are not drilling multi-million-dollar wells. They're not doing hundreds of millions of dollars for offshore platforms. These are guys who've made their living for decades with a bunch of old wells. The risk of not being able to pay for plugging liabilities is not unique to new assets. The greatest risk exists to those assets that already exist and are already depleted. It certainly applies. There may be issues with declining price that could strand new investments. But for wells in the US, whose average age is 36 years old, this is already a present issue regardless of the energy transition.
Great. So, and then maybe a follow-up question in this area here. And that's more about what it actually costs to plug these wells, because as Mike highlighted, well, things are going to be accelerated, prices will likely come down as demand comes down. But are there difference in plugging costs from if you have a totally empty or depleted asset versus something where there's still actually a lot of resources underneath, but they're no longer economic to produce? Well, do they cost the same?
They do cost the same to abandon. The costs that we have paid in the past can be viewed as a minimum of what can be expected to be paid in the future, because the demand for plugging operations has been minimal. At the same time that the materials themselves have been aging, maturing, decaying. So we can expect a systematic risk on the high side above current costs of plugging, regardless of a well at the end of its life or prematurely unprofitable.
Gotcha. Fantastic. And then maybe come back to one of the points Stephen made towards the end in terms of the usage of the holdback of this methodology, and that maybe more like an open question to you on what is from your point of view or from our point of view at Carbon Tracker, what is really our aim here? Is this framework aimed towards the regulators to get them to implement and stress test companies, etc., or are we more aiming to get this out to investors to start to put pressure on companies to say, hey, you guys you're promising us all this dividend out in the future, but we don't think you can pay this, and banks to say, well, we're lending you money to do this, but you don't have money to pay back our loans. What is our target really with this methodology?
That's a great question. I would say the short answer is yes to all of those targets. Quite frankly, the risk here, it's hidden in the market, and where it falls just depends on where you're sitting when the music stops on a particular project. Is it going to fall to a particular investor, to a company? Is it going to fall to taxpayers? I think broadly speaking, because there aren't funds set aside, it is incumbent upon regulators to plan better and to improve regulations to ensure that there is some sort of funding set aside to protect taxpayers and to protect public health and the environment from these issues. But investors are on the hook too. And quite frankly, the best cure, in my opinion, or at least the first step towards a cure, is for people to understand this. And that includes all relevant stakeholders, includes investors, includes companies, includes, reserves evaluation professionals, et cetera, et cetera, et cetera. Dwayne, does that line up with your thoughts?
Yeah, no, I agree with that. The holdback is not a propaganda item. This is a useful, valuable measure for planning finances in the future. And for oil companies, it's relevant to try to avoid bankruptcy. For the owners, it's relevant because their dividends could be suddenly cut off. For lenders, they could find themselves in bankruptcy with operational obligations that supersede their first lien priority. And for regulators, they're looking at the possibility of, in the case of Texas, unfunded liabilities equal to 100% of the annual budget of the state. So ideally, the issue starts with regulators, since their behavior has created this moral hazard. But it does create risks for everybody in the system.
Gotcha. Interesting. And then what maybe Dwayne, you can talk a little bit. What has been the response when you have brought out and discussed this? Because you can say to some extent you're taking on the almighty discounted cash flow modeling, DCF modeling. Everybody with a finance degree have been doing their share of this. So basically, what has been the feedback, pushback been?
Well, the first part of that, I think, is that I'm not displacing. Holdback does not displace discounted cash flow analysis. It supplements it. And it supplements it with an idea that is perfectly consistent with the first principles of discounted cash flow analysis, the principles of timing and of risk. So it's a supplemental, not to make up for the fact that the discounting ignores the known liabilities and treats them as risky when they're not. Now, as for how it's been received, I've had conversations with engineers, engineering firms, operators, software companies. The strongest pushback to the idea so far has come from a software company who didn't want to implement a new calculation. But no one has said, and the operators have sometimes not been happy. They didn't always want the report to be published. But no one has said this is not, other than the software company, said this is not valid or appropriate measurement. Ironically, the ESG rating agencies don't seem to have clued into this risk yet.
Gotcha. And that actually, that maybe I could bring in another point here. What about the credit rating agencies? Because I think that seems to be another faulty area, another area where this should be part of the future financial structure of companies.
So I'm going to let Stephen clarify something I get wrong here, but in my experience, the disclosures under GAAP rules require discounting of the AROs and reporting of undiscounted only for a handful of years. But the regulations, the system that exists, allow those costs to be delayed into the future, even after the wells have a legal right to produce. They are allowed to sit idle on other people's property. And therefore, the systems we have in place do not show the true magnitude, the true presence of the liabilities. But what's more, a lot of companies aren't required to use GAAP accounting, aren't held accountable for those. Stephen, you want to clarify any of that, amplify?
Yeah, and specific to credit rating agencies, we've just had some ongoing conversations with some credit rating agencies really don't pay much attention to AROs. Notably, S&P treats them as a liability. They make efforts to incorporate those into their valuations. I haven't seen their model, so I don't know how sophisticated it is. And generally speaking, if you're working off of the audited financial statements of major companies, you're going to be missing a big piece of the picture, because those, for reasons discussed in other Carbon Tracker reports, feel free to follow up with me if you're interested in hearing more on this issue. But audited ARO reports are essentially opaque. They offer very little informational value, and so anything that's modeled off of those alone is going to miss a big piece of the picture. I'm sure that S&P does a few extra steps, but again, I haven't seen their modeling. I don't know. I know they are interested in learning more, but I think we still need better data, and I think a rising sense in the marketplace that this is an important issue.
Great. So to pivot a little bit, we have a couple of the question here from the audience also coming in here, and maybe that's more aimed for Mike here in the beginning. There's actually two questions from the same here, but maybe the first one that could also be to all of you. But we're very focused on the US here, but what about the other major oil producing areas like Middle East, etc., who have vast reserves? They also have much lower production cost and so on. How do we feel? How do we look at this? Is that something we are feeding into it? And maybe more specifically for Mike, when we look at the oil replacement or displacement from electric vehicles and so on, what about the more heavy transportation? They use quite a lot, but we don't have a lot of the technologies here. How do we factor that into our assessments? Mike first.
So I'll ask those in that order. So the first one of how do we factor in the major oil producing regions, the Middle East, the national oil companies, or the state-owned investments? The reality is we cover in the modelling. So some of that work I showed you there, looking at future supply, and then for future sort of committed supply from existing and future potential supply from potential new project options. We consider global oil and gas supply, looking at a number of different scenarios, including those of the IEA and others as well. So absolutely, we factor in production from all companies listed, private, state-owned, and obviously the partially listed companies too. So the reality is the cost of production, as in the question, is very low in the Middle East. That ultimately is driven by government environment, the political environment, the fundamental geology, the development environments, onshore, large fields, and there are other potential project options out there. And actually, if you look at that sort of a quite fast transition scenario, if you like, of say 1.6 degree pathway, that, for example, the sustainable development scenario, that blue wedge I showed, the reality is under such a pathway, the new project options that are viable on a cost curve basis, and do read our main reports where we sort of go into this in far more detail. But the reality is that it's predominantly those Middle Eastern countries and some other NOCs that have, and the petrostates more broadly, that sit on some of those lowest cost project options, and therefore those that are most resilient to some extent from the risk of stranded assets. But that's not to say those countries won't have a loss in future revenues from their existing projects. So as prices fall, then the revenues they receive will also fall. And for many of those companies and the petrostates more broadly, those revenues make a far greater proportion of overall income than for companies, so the non-petrostate countries, and so the risks are slightly different, and also those petrostates, those countries which are investing in the Middle East, their economies are heavily reliant on oil and gas. So the transition will impact them differently, and there are fewer options to diversify their economies, as opposed to, say, a listed company which could choose to return capital to shareholders for them to invest elsewhere, or the company itself could redeploy that capital itself, whether that's into moving into renewable energy supply or into moving into other business sectors too. So in some ways, the listed companies have a greater potential exposure, but equally have potentially more strategic options to plan ahead and do something about it. For the petrostates, and we wrote a report about this last year, really it's about diversifying the economy and accepting that income from oil and gas will fall, and it may not be able to be replaced. But don't overinvest in the short term chasing that revenue, otherwise your revenues will fall even further. For the second, could you remind me of the second question, Henrik?
Yeah, on heavy transportation, how we factor that in. There's not a lot of solutions for that.
Yeah, I mean, so I work mainly on the oil and gas, but sort of speaking some of the work that those who are looking at the energy transition, I think it's about, obviously light transportation makes up a significant portion of that demand. So there are obviously existing solutions which are materially going to impact demand, and those other technologies will undoubtedly develop over the decades to come. And batteries are growing, other alternative fuels as well. And so obviously, while you can have, I think we need to always, you can have fossil fuels. So petrol is viewed as a fossil fuel, but of course you can have a greater ethanol content. You can have biofuels. You can have other liquids that have a greater fossil component. You can even have green hydrogen produced from renewables, which is then sort of liquid as a fuel. So I think it's worry about the hardest to abate sectors as we decarb, but there's still a lot of easy decarbonisation to be done first before we get to worry about this hard to abate sectors. But also then, similarly, we get questions around intermittency, for example. So again, let's worry about we can solve a lot of this and leave those, and will have a big impact on reducing oil demand, so creating risk exposure to the companies, but also which will in turn reduce emissions as we go through.
Fantastic. And then, so coming here towards the end here, so we have a little bit of a lightning round, a couple of questions here, but this is a lot about investors, how companies are working. You as an investor can be exposed. How can you protect yourself? What can you really do in order to utilize this? What are the measures you can take? As part of this is, do we have the Harry Potter technology? Is there some new technology that can come and make this easier, just like CCS or these other areas that a lot of people are putting their faith into, but has still not really been deployed at scale? Are there some kind of ways that technologies can come in and help us? And what are maybe, that maybe for Dwayne, but what are some of the key tricks companies are using to try and get around this area?
Well, okay, 3 questions. The way that companies avoid this now is the same way they have for years, which is to sell the asset. Companies will, larger company who's more financially stable, broader diversified portfolio of assets that could fund the plugging, will take something that's late in its life, non-core, and sell it to a smaller company. In so doing, the liability gets ring-fenced with the asset. That process has been allowed, and the deferral of plugging liabilities along the line has been allowed by virtue of changes in regulations following the 1986 price collapse. The investors in the larger companies right now will probably have the ability to continue to have that out. Smaller companies will not, but more importantly, those regulations are likely to change. At some point, when the risks are recognized, the most sensible intervention from the regulators is to disallow a transfer from a larger portfolio to a smaller, and then, unless there's a solid financial assurance. And at that point, these large liabilities that have been ignored come to roost in the asset balance sheet where they exist. Now, the hope has always been technology is going to solve the day. That's not the case with plugging. The technology we use to plug wells right now is the same technology we've used since the 1960s. Although we place the technology slightly differently, that innovation happened in the 1970s. There is no active research on alternative plugging methods. There's no belief that it can get any simpler or any cheaper. What we do right now is simply put cement in the hole. It's really hard to imagine a cheaper material or a cheaper process. Did I answer all three questions?
Yeah, maybe you as an investor, you're sitting from the outside, because maybe follow up here, because you sell your assets. It also, the case study we have shown is you're selling it maybe to privately owned companies where there's even less disclosure. So what are you going to do?
Well, there is one other issue that an investor has to face, and that is that the buyers are increasingly recognizing the existence of this liability and factoring it into their purchase price. So it used to be more than 5 years ago or so that people hardly factored retirement obligations in at all to their purchase decisions. But now at least half the buyers, in my experience, are considering asset liabilities or retirement liabilities in their purchase price. So a company who may want to sell their asset may find that they're getting a much lower value. The first thing to do is to measure the issue. Do you have enough money, given the uncertainty in prices and the uncertainty in late life production, to cover all your plugging liabilities? If you do, then you can make a plan on how to protect yourself. And if you don't, you have a whole different set of problems.
Yeah, I think this ties into some recommendations we've made in the past year, which is that from an investor standpoint, you really want to know how your company is dealing with these risks. And for the most part, companies are pretty tight-lipped about that. And that includes the largest companies. And some of the largest companies have other risks. They may be exposed to joint and several liability, particularly on offshore oil and gas assets. Or they may be exposed to litigation if there's, if a transaction goes through and then the successor company fails, and the bankruptcy trustee might be interested in suing for recovery on some of that. And so what we say to investors generally is, we should be demanding better reporting on AROs themselves, the full costs, the undiscounted costs, the key critical accounting estimates that go into making those costs on the balance sheet, to estimating those costs on the balance sheet. And then what's the plan? How does this particular company intend to fulfill its obligations as they come due, especially in light of the energy transition, and certainly, as Dwayne mentioned, just in light of the widespread field decline already present in the United States.
Fantastic. That marks the end of the questions here. So there's a couple of more questions. We'll go directly back to you with some answers on them. Last, I will make a little plug for next Wednesday in New York City. New York Climate Week there's a lot of activities in New York. Carbon Tracker has a full day of activities on Wednesday, September 21st. Look on our website for the event. You can sign up. We will be talking both about the stranded liability, the stranded asset discussion more in depth. So any questions you haven't had answered here, you have an opportunity to follow next week. So with that, I want to conclude this webinar. Thank you so much to Dwayne, Mike, Stephen, and to everybody else at Carbon Tracker. Everybody else, have a fantastic day. Thanks.
Thanks very much, everybody. Take care.